Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, and sponsored by Revival Gold, in which we take a closer look at some of the most interesting news items in the mining and exploration space. Joining me today is Neil Adshead, consultant analyst at the Commodity Discovery Fund. Neil, welcome back to Kitco.
Thanks, Paul. Great to be here again.
We have a lot to talk about today. A great year for gold, and while we're approaching the festive season, rather than ho ho ho, it's the nightmare before Christmas with the news filled with ow, ow, ow. Mali has issued an arrest warrant for Mark Bristow of Barrick Gold, not because it is unhappy with the company's share performance. Imperial Metals and the Mount Poly mine in British Columbia, Canada, have been served with notice of charges alleging violations of the Fisheries Act following the tailings dam failure there about a decade ago. Jaguar Mining shut its Turmalina mine in Brazil after a tailings failure engulfed mine infrastructure. No injuries were reported though. And Torex Gold reported 3 fatalities from carbon monoxide poisoning at its ELG underground mine in Guerrero in Mexico, with operations subsequently suspended by the Ministry of Economy. Neil, where do we start with these? When it goes wrong in mining, it seems to go very wrong.
Yeah, you could say that. I mean, you could view it as a hazardous business. You know, we do hear stories of injuries and, unfortunately, fatalities. Obviously, terrible news out of Mexico. But you know, when I was reading a little bit, I do read a little bit on statistics in sort of industrial accidents. You know, and you'd be amazed maybe to hear that, say, the agricultural sector, for example, you know, has far more deaths and accidents, say, in the United States than the mining business in the United States. So, you know, soft-bodied humans moving around heavy equipment underground and around mine sites. Unfortunately, there are accidents. People do get hurt. But I think the mining industry, if you look at the safety record over 20 to 30 years, it's improved hugely.
Absolutely. Let's dig a little bit deeper into some of these headlines that I read out. Neil, Resolute Mining paid to free its executives a few weeks back in Mali, and now the military junta there seems to be after Barrick. Is this a sell call on any mining or exploration company in Mali right now?
I would put that down to your own personal risk profile. I mean, I've been to Mali. I must admit it was a bit of a strange place compared to some other countries I've been to, especially in Africa. I personally wouldn't be invested in Mali right now, but I believe the mines are still operating fine. There isn't a problem at the mine sites. It's just, you know, these military, these sort of youngish guys with guns who've taken control of the country. Same in Burkina, same in Niger, you know, these neighboring countries. You know, they are in control and they're looking to make some money. And just to go on a little tangent here, there's a very fascinating book called The Dictator's Handbook, if anybody fancies a good Christmas time read. And the first rule of being a dictator is find the money, because that's how you're going to stay in power. And that's exactly looks like what the government, especially in Mali, is doing right now. It knows the mining companies are making a lot of money at the gold price, and they're taking as much money from those mines as they can without killing the mines.
That, I think, Neil, is also the first rule of journalism, follow the money, although I'm not sure many journalists upgrade to becoming dictators, though, but we'll see what we can do about that. Hey. Now, you mentioned Niger, Burkina Faso, they're also providing challenges to mining companies. Does that create a bit of a risk-off situation for West Africa as a whole?
It's an interesting question. Now, as a geologist, West Africa is fantastic for especially the gold potential across the district, all the way from, say, Senegal, you know, say up to Nigeria, all the way across there, from the coast in Ghana up to the Sahara Desert. Fantastic gold potential. So as a geologist, it's an excellent location to go to. Now, there's roughly a dozen or so countries spanning that area. Each country's different. Each country's got different leadership. You know, some countries start off good and then they become poor investment jurisdictions and vice versa. You know, there's a civil war in Cote d'Ivoire maybe 20 years ago, and Cote d'Ivoire is the shining light for mining companies at the moment. And, you know, Burkina, unfortunately, has sort of slipped in the opposite direction, and same with Mali. So it's hard to blanket the whole of West Africa as being, you know, a poor investment jurisdiction. You'd have to do the research yourself on each of those jurisdictions, and they are all quite different.
I think I would agree with you. You have to do the research, and unfortunately not everybody is prepared to do that. Now, Torex Gold Mines. We discussed Torex on Digging Deep a couple of weeks ago, but that was in the context of a single asset gold miner undertaking a share buyback program rather than perhaps buying a second asset. And this event at ELG perhaps indicates or exactly why it's good for single asset companies to get that second asset. Torex is down about 15% so far since that news came out, and obviously that could fall further depending on when ELG may reopen. I think it's interesting to contrast this with what happened with SSR Mining earlier this year, which sold down after a tailings failure of its Kupla mine in Turkey, but being multi-asset, it's since bounced back strongly. Neil, as an investor, what is your view of single asset developers and producers? Is there a point that you sell out of single asset companies because they have that single asset risk?
I wouldn't say that. It depends on the quality of the asset and the company and the risk profile it's dealing with, I suppose. I mean, you got Torex on one hand, but you can compare it to, say, Lundin Gold, with an $8+ billion Canadian market cap, and the share price has done extremely well. The mine's chugging along, producing roughly about the same as Torex. So I wouldn't just chuck all the single mine companies into one basket. It does help to have a second or a third or a fourth asset. But again, say at the management level and the board level, if you've got a pile of cash, you're deciding what to do with that. If you can't find that second asset, what is the best thing you can do with your cash? If you think your share price is seriously undervalued, you should be buying the shares back if you haven't got an alternative growth plan. Now, no doubt Torex is keeping a very healthy war chest there in case something does come along that takes their fancy, but as is at the moment, they're not seeing it. I'm sure they've looked at 100 opportunities, and I can say from personal experience, there's not a lot of great undervalued gold mining opportunities sitting out there that everybody hasn't already looked at.
To what extent do you think, it's one thing for management to say, look, we don't think there's anything that really adds value, but to what extent or not could the key shareholders get involved and say, look, we're uncomfortable with having single jurisdiction risk. We'd like you to diversify, and really putting a push on, okay, we need to diversify our risk. Yeah,
I mean, big shareholders will do that. I would maybe argue if they probably know the company very well, they may even be privy to some of the opportunities they've looked at, and they're also looking at opportunities around the world themselves as investors. And maybe they've pitched a couple of names, but ultimately, I suspect, the company is in charge, so to speak, the company and the board of the balance sheet too. They will make the decisions that they think is in the best interest of the shareholders. I think ultimately, if the shareholders disappointed at owning shares in a mining company that's only got one mine, maybe they need to look at themselves and diversify themselves rather than being so concentrated if they're concerned by that concentration risk.
I think that's a valid point, Neil. Investors can diversify perhaps much more easily, have more opportunities to do so than perhaps a single company. Okay, continuing with the doom and gloom, another Canadian company is heading for the exit, Switzerland to be precise, with Lithium Argentina to re-domicile so as not to be subject to government overreach related to its investor Ganfeng Lithium. This follows Solaris Resources heading to Switzerland so it can get Chinese investment. Neil, are the risks Canada perceives in Chinese mineral investment overblown or justified, do you think?
I think it's geopolitical. I think it's geopolitically driven. I don't really think Canada has a particularly strong anti-Chinese view, if that's the right word to use. I mean, it comes across as they do, but living in Canada myself, I would argue the United States is really pulling the strings here, and they're essentially not blackmailing Canada, but they're encouraging their closest ally, let's say, to toe the same line as the United States, and to be a good buddy and a good neighbor, and to deter China from gaining a little bit more control over the raw materials that, are becoming increasingly scarce and the world needs. And the United States needs Canadian resources. So I suspect it's a little bit of geopolitics. I'm sure Canada's getting something positive in return that we don't really know about.
And I think this opens up the bigger question, Neil, that, with China being one of the main countries investing in metals and mining projects, across the board. If the money's not to come from Asia, and China specifically, where will it come from to advance the projects, particularly transition metals that the world so desperately needs?
Well, there is also a lot of capital in Asia outside of China, ex-China. The Japanese, I think I saw last week, there was a big investment by maybe Sumitomo into a copper asset in Chile. The Koreans are investing internationally. India has a lot of capital. We've seen the Arabic nations investing too in different places of the world. So yes, there is a lot of Chinese capital. I think if these sort of investment constraints weren't there, we'd see a lot more Chinese takeovers, especially in Canada, especially, and maybe even in Australia. But the way it's going, there's a huge amount of capital in the world. Yeah, China has had this initiative to push for 20 years, get exposure to as much of it as they can. The West has been a little bit sleepy, but I think we're starting to see the EU and the United States and Asia ex-China stepping up a little bit now. So I don't think there's a shortage of capital. There's just now, it looks like China's been a little bit locked out of the party, so to speak, by certain Western nations.
Now, you mentioned the Middle East, and a lot of that is coming from Saudi Arabia, and they're hosting the Future Minerals Forum in January, and Kitco Mining will be there. Now, whilst we're still on the Canada risk aspect, could fission uranium follow? Palladium Energy has warned that its 1.14 billion Canadian acquisition for fission for the Patterson Lake South U308 deposit in Saskatchewan may fail to close as the Canadian government extended its review of the transaction due to concerns over Chinese ownership of Palladium's Langer Heinrich mine in Namibia. Neil, it's taken a very big step back with naked short selling at one end and government interference perhaps on the other. If you were to launch your own junior exploration company, where would you list it?
Again, depends where I'm living. I don't really want to be on phone calls at 3 o'clock in the morning. That's a big part of it. Based on the stock exchanges of the world, in my opinion at the moment, I think the ASX is probably the best place to list. There's a lot of capital available for juniors in Australia, despite the population only being sort of 25 to 30 million. The superannuation scheme there essentially means almost every pensioner, every working person retires with $1 million+ in the bank, and Aussies like a gamble. There is actually a lot of capital in Australia for an early stage exploration company if that was the kind of company I was running. But that said, if I was living in Toronto or maybe in London, maybe I wouldn't list there because I wouldn't like to be spending my evenings on the phone every day of my life. So, they're always different. They're always different considerations. But if I was willing to move, moving to Melbourne or Sydney and listing on the ASX would be rather nice.
Okay, it would be bad for us though because we wouldn't be able to have you on Kitco Mining's Digging Deep. Okay, indeed. That was the bad, and now we have the good to come, and perhaps a little bit more bad, following a word from our sponsor, Revival Gold.
Revival Gold, ticker RVG on the TSXV and RVLGF on the OTCQX market, is one of the largest pure gold mine developers in the United States. The company is advancing engineering and economic studies on the Merkur Gold Project in Utah and mine permitting preparations and ongoing exploration at the Bear Track Arnett Gold Project located in Idaho. The company is financed and currently focused on the completion of a preliminary economic study on heap leach gold resources at Merkur and continued exploration along 5 kilometers of underexplored structure at the company's multi-million-ounce orogenic gold system at Bear Track Arnett. For more information, please visit www.revival-gold.com.
Lundin Mining is selling its Neves Corvo and Zinkgruvan zinc and copper mines in Portugal and Sweden to Boliden for up to $1.5 billion to strengthen its balance sheet and support its growing portfolio in South America. Key among its South American operations is the Vicuña district, including the Candelaria and Caserones mines in Chile and the Jose Maria development project joint venture with BHP in Argentina. Neil, it appears the Lundins are getting ready for a big investment phase, and presumably that will be in Argentina and Chile, as I mentioned. What do you think they are contemplating there?
Well, obviously, has to be a massive commitment to the JV they've got with BHP on the Filo and Jose Maria. I suspect BHP is going to want to push forward as quickly as possible, as quickly as the regulators allow. And the Lundin family, let's say, have not known for sitting back and taking it easy. I think they're going to be going full steam ahead too. So I suspect it's going to go into the development of Jose Maria and the Filo project.
Now, Jose Maria is in Argentina, as we mentioned, and Argentina is where President Javier Milei has just completed the first year of his term, and he's just announced that he's cleared the public debt in Argentina for the first time in about 123 years. Neil, will a tax agreement for Jose Maria perhaps be the next feather in his hat?
Well, it would be a great headline for him. Yeah, it showed to other foreign mining companies, foreign resource development companies, including in the agricultural sector and various other sectors, that Argentina is open for business. So I think once you get maybe that first domino to fall, you'll see additional FDI come into the country for sure.
Now, Neil, we were both in Mendoza in Argentina about 2 weeks ago at a mining investment conference. During the conference, the governors of the 5 northwest provinces that have the most potential for copper and lithium signed a collaboration agreement. What were some of your takeaways from that mining event?
Oh, it was incredibly positive to be there. I was expecting, maybe 50 to 100 people in the audience, and I was surprised to see. Basically, it was sold out. There was 500 people there. There was lots of business people in suits, lots of service providers. Seeing the 5 governors of one nation, 5 provincial governors sitting on stage, discussing how they wanted to attract investment into their provinces and into the country. I don't think we'd ever see that in the United States, or would ever see that in Canada or Australia, for example. It was very impressive. And they hung around for photographs and to shake hands. And yeah, it was just an excellent vibe came out of the conference. And I think, Mendoza is looking, the future is looking a lot brighter than it has for the last 15 years for mining companies operating in the province.
Now, Argentina is generating a lot of news headlines because of the economic turnaround in publications like The Economist and other leading economic and business news publications. I guess for the mining sector, the key will be, though, getting that first 1 or 2 agreements across the table and getting some mines into development.
Yeah, for sure. I mean, I saw a stat, I think it came from RBC, that showed of the sort of copper resources in the ground development projects, Argentina essentially could provide 6% or has 6% of the world's copper projects where they could be developed into the mines, say, over the next 20 years. But presently, Argentina produces 0 pounds of copper. So there is huge development potential in the country. It just probably really needs that first little domino to fall. The first, somebody breaks ground on a big copper development project, and hopefully you would see 4 or 5 others have the bravery, if that's the right word. So to commit to multi-year, multi-decade investment in the clearly prospective country. Okay,
well, let's hope that first agreement, that first groundbreaking, isn't too far away into the future. Let's have a mine financing. A company who's raised funds recently is Allied Gold, which entered into a streaming transaction with Readers Precious Metals for $175 million to develop its Kermit project in Ethiopia. Allied expects to conclude a gold prepay as the final component of the financing package for the construction there. Neil, it seems more and more companies are avoiding traditional project financing debt for their builds. Is this because debt is too expensive, debt is unavailable, debt is too restricted with covenants, or something else, do you think?
I think it's some of the reasons you mentioned. These groups today, and there's quite a few of the especially listed companies providing, say, streaming and royalties. It is like a bit of a hunting pack. It's a small group of talented, smart, motivated individuals who can move a lot faster than a a cumbersome, say, UK bank, French bank, American bank, Canadian bank, that has all sorts of regulations and hurdles they've got to go through. So, I was a debt analyst for a while, part-time, working at one of the investment firms I worked at. And it was quite interesting. Quite often the debt would take weeks to months to put into place. Whereas I suspect some of the due diligence that these streaming guys and the royalty companies can do can be actually relatively fast. And if you're sitting there waiting for 6 months for approvals, and you jump through all these flaming hoops trying to get approvals, you do sometimes get a bit tired of that, and you take the streaming opportunity, which maybe it costs you an extra couple of percent sometimes on the headline anyway, but it's just easier. It just gets it done quicker. And every month you delay the start of the construction of your mine, it costs you a lot of money.
Okay. How important is the development of Kermit, do you think, for Allied, considering that its Sadiola mine is in Mali, where it recently secured a 10-year exploitation permit, and obviously there are a lot of concerns about Mali at the moment?
Well, clearly it's crucial. It is one of the big growth projects for the company. Ethiopia is quite an interesting country. I have visited a couple of mining projects in the country. There's a lot of people there, and there's a lot of demand for growth too from a very young population. So and I know people who've been to this particular asset, and they talk highly of the geology. So yeah, if everything aligns, this could actually be the core asset of Allied going forward. Obviously, Sadiola, bit troublesome given what's going on in Mali right now, but as we know in different nations, government can change pretty quickly. There could be a move at some point to democracy in Mali, and all of a sudden Mali is amazing, just like Cote d'Ivoire is at the moment in West Africa.
Okay, well, let's have some M&A. News out this morning, Agnico Eagle Mines is to continue its consolidation of the Val-d'Or district in the Abitibi in Quebec in Canada, having agreed by OIII Mining $204 million Canadian in cash. Agnico will add the Marban Alliance property, which is 7 kilometers from its Canadian Malartic complex, and that includes 1.6 million ounces of gold reserves grading just over 1 gram per tonne, and about 2.9 million ounces of total resources. The $1.67 per share purchase price represents a 57% premium, but many O3 shareholders might challenge O3's claim that the deal is a, quote, excellent outcome, unquote, as for some, it is likely to be a take under. The premium announced is essentially what O3's share price was at the start of 2024, since when it has declined in value by 32%, despite the gold price hitting all-time highs and rising by about 30% this year. Marban's tuck-in potential for Canadian Malartic was recognised years ago, propelling O3's stock to a high of $3.20 per share at the end of 2020, since when it has declined by 67%. With Agnico always the likely buyer of the company, the major was able to make a bid at its leisure. Neil, another great deal for Agnico, with another opportunity to benefit from the Malartic infrastructure investment it's made there over the years.
Yeah, looking at the geography, I suppose, is the best thing to reference. Really, I don't think Marban really was good enough to justify building a new, processing facility in that location. It made so much sense for the material to go through the Canadian Malartic mill owned by Agnico. Agnico's open pit, I believe, last time I looked at it, it's due to be exhausted in 2 to 3 years, and then it was all from underground. And the underground material they could mine is, it doesn't essentially fill the mill. So to bring Marban into the mine plan made so much sense for Agnico, but Agnico obviously held all the aces in the negotiation and just bided its time and waited for the moment when it, lobbed in the bid, which was this morning. And there wasn't really much O3 could do about it, because I don't think they were really motivated, or they really wanted to build a new mine at that location. It makes sense for everybody. It's just unfortunate sometimes how the timing works out for O3 shareholders. I was an O3 shareholder when I used to manage fund about 3 years ago, and it was great in 2020. It went all the way up to, as you said, 320. But unfortunately, with only one acquirer, people lose interest, and here we are today.
I think O3 previously mentioned that not having to build a mill would save them about $200 million in capex. So, as you say, this deal was always on the cards. And I think some people view this as perhaps a capitulation deal by OIII, or maybe they're relieved that it's finally over. And it's interesting that you used the word motivation, Neil, because a lot of people have been crunching numbers this morning around the deal, and it perhaps suggests that motivation might not have been getting the best deal for shareholders. OIII also has about $40 million in cash and stock of other companies, which means Agnico is paying about $50 to $60 per ounce for the ounces it's getting. However, change of control payments for management are very, very substantial. Neil, so would change of control payments play a factor in management agreeing to a takeover deal like this at this time?
Every case is different, and I'm not going to specifically talk about OIII, because obviously I'm not inside the company. I don't really know what the decision drivers were for the executives and the board to sell the company now. Change of control clause it's an interesting compensation route for executives. Australia is quite interesting. The ASX has a cap of 1 times your salary, basically, as a change of control clause. But in Canada, in recent years, there's been sort of inflation, sort of a creep in change of control clauses going from 1x salary, and nowadays you see them at 2 to 3x salary plus bonus. Average bonus over the last 2 to 3 years. So they can get quite substantial. And sometimes the change of control payment is more than the person's annual salary by multiples, and also more than that individual's equity, the value of their equity position. So when you think about the motivation there, they're actually motivated to sell the stock at the actual share price is irrelevant to them, because they make all the money out of the change of control clause, which is essentially fixed to their salary plus bonus, not fixed to their equity position, which I think is wrong. But that's the way the regulations are in Canada. Canada's got no cap at the moment, as far as I'm aware, on change of control clauses, whereas Australia does.
I think this transaction also shines a light on executive pay at junior exploration companies. Now, OIII isn't a producing company, and yet the CEO is on a basic package of over 500,000 Canadian dollars per year, which, considering you could argue the decline in the share price over recent years, seems to be a bit rich. Neil, when you look at investments, to what extent or not does CEO pay come into your decision making?
The CEO pay is obviously one of dozens of things that I will look at. I'll look at the change of control clause too. What I really want to see from a CEO is that the CEO is so heavily involved in the equity, and that individual is going to get rich by the company being successful from their equity gain, not necessarily from their salary plus bonus or their change of control clause. I really want to see the huge equity exposure, because that essentially is the only way I make money as an investor, is through the equity going up. So that is one real thing I look at from the compensation structure.
Okay, another take under may be underway, as Condor Gold says it has received an offer for its permitted 2.4 million ounce La India gold deposit in Nicaragua from Metals Exploration. Many people thought it would be Calibre Mining bidding for Condor, which has its hub and spoke network in Nicaragua that produces over 200,000 ounces a year. But no, it's Metals Exploration. They're going to make an upfront payment of $84.3 million plus an additional $28.8 million in deferred payments tied to production milestones, potentially a 65% premium there. Neil, a sale is something Condor Gold has pretty much wanted for a long time. Are you surprised at who the buyer is?
Everybody would have thought it would be Calibre or somebody else operating in Nicaragua, like, say, Mineros. I suppose it goes back to your comment on diversification. I would never have picked Metals X would buy this, but then again, there could have been dozens of companies that you wouldn't have picked would potentially buy it. Maybe somewhere in the background, and we don't know this right now, maybe you have to scratch beneath the surface. Maybe there's some sort of personal connection there we don't know about that resulted in this acquisition. If I'm not mistaken, I think both companies maybe have a London HQ. So maybe there's some sort of buddies overlap there in these two. For Calibre, they seem to be doing well in Nicaragua. They've been there for many years. They're making money, but we've seen Calibre's growth. They've chosen to first invest in the United States, in Nevada, and secondly in Newfoundland. And I think they want to diversify out of Nicaragua, not because they dislike Nicaragua. I think they just don't want more Nicaragua because investors generally don't understand Nicaragua, even though it's probably the only, or one of the main, it's probably the favorite or favored jurisdiction to invest in mining in Central America. But most people probably still remember the Contra scandal from the 1980s, and when they hear the word Nicaragua, they think of left-wing mercenaries and stories like that. So I think Nicaragua has a bit of a reputation challenge. Ortega is a sort of a left-leaning dictator, to use that word again, and he gets negative media around the world. I'm not saying he's a good guy, but he seems to leave the local mining industry alone. But I just think it was more Calibre looking to get out of, to have less Nicaragua exposure. And going back to Condor, yeah, the project's been on the for sale for quite a long time. Mark Charles done a good job there, stick handling it this far, but I think he just run out of steam and he was looking for a buyer. And sometimes when there's not that many buyers there in a big queue, you take the best one that gives you the offer at the time. And good on him. He's checked out. He took it this far. Whether shareholders made money is really depending on when they bought the stock. But hopefully we have a happy buyer and a happy seller, and hopefully some happy shareholders.
Well, Mark, I think, is a 5% shareholder of Condor. And I think there are some parallels with what we were talking about earlier with O3. Condor's share price a few years ago was double what it is today. And obviously you can't tell what the future will bring. But it does seem that in both instances, the companies would have been better off selling years ago, but perhaps they got hung up on valuation and held on too long for the perfect deal. And as things transpired, their share price eroded as bidders didn't come through. I imagine that's a very difficult thing for a CEO to judge at what point to let a company, let an asset go, what valuation to take, how hard to fight for valuation.
Sure. Well, I mean, it's not entirely the CEO's decision. Really, the CEO is hired by the board. There are occasions I've heard anecdotes where an offer comes in and the board, the CEO probably wants to do it, but the board decides not to do it for whatever reason. And sometimes you may be trying to sell an asset for years and years and years, and you just don't get the bid that makes any kind of sense. So it's a funny thing, M&A. It gets done quite often for strange reasons in the background, which you never hear about, or you hear about them 5 years later down the pub by somebody who was involved, a banker or an executive. And it's kind of weird, strange sometimes how and why deals get done and when they get done.
Okay, let's end on a big positive for exploration, and that is courtesy of Barrick Gold, which entered into an amendment to the existing exploration earning agreement it has with Precipitate Gold regarding the Pueblo Grande project adjacent to its Pueblo Viejo mine in Dominican Republic. Barrick agreed to increase and extend the earning totals required work expenditures from the original $10 million to $22 million. Congratulations there to Precipitate. Neil, Barrick is continuing to go with its exploration-heavy investment strategy. It seems to be investing more in exploration than its peers and getting results in terms of adding ounces cheaply. However, it does seem perhaps that the market doesn't care so much for that, though, and wants Barrick to do something more aggressive. What's your view on Barrick's focus on exploration rather than perhaps going external?
Yeah, I mean, I've not compared. I'd have to compare how much Barrick is spending on exploration compared to, say, Agnico or Kinross or Newmont or one of the other big gold producers. So I'm not exactly sure whether Barrick is, outperforming, let's say, on expenditure on exploration. But for a company like Barrick, it's plus, if I'm not mistaken, it's plus $40 billion market cap, sorry. It's going to have to be a pretty amazing discovery to move the needle from a share price point of view. So, for example, say Barrick discovered Snowline's, great deposit out there in outback Yukon. Snowline doesn't even have $1 billion market cap. So if Barrick discovered the Snowline deposit, adding that value to Barrick's market cap is less than 2% or roughly 2% of Barrick's market cap. And Barrick some days moves more than 2% just based on their on sentiment in relation to the gold price. So a company like Barrick, yes, it's great they explore, and Newmont and all the others, but it's not really going to move their share price unless they find some, super duper 20 million, 30 million ounce deposit right next to an existing mill. So it's great they do it, and they kind of have to do it. But the only way you're going to really move Barrick's share price is really commodity moves or some M&A. Either they get bought by somebody or Barrick buys somebody that's sizable, and it has to be sizable to move the needle for Barrick's share price.
All roads lead to M&A. That's it for this week. However, Kitco is working on its Mining and Exploration CEO of the Year Awards, so please send your nominations to us in the comments section below. And of course, don't forget to hit that subscribe button. Neil, thank you very much for joining us today.
Thanks, Paul. It's always a pleasure.
And I'm Paul Harris, and this is Kitco Mining.